Stocks sell at silly prices from time to time. It doesn't take a high IQ to figure out that they're cheap, but it does take a temperament that's willing to step up and actually act.
I'm sure you are all aware Mr. Warren Buffett, the 92-year-old Oracle of Omaha, will be speaking on that day. As the CEO of one of the biggest corporations in the world, Berkshire Hathaway, he will be in attendance. Moreover, he is the world's best investor, which is why the majority of people are familiar with his name. He issues a letter to his shareholders every year in which he outlines the performance of Berkshire Hathaway stock since he assumed control in 1965. And get this, over the course of that time, he has returned an average of 20.1% annually, compared to the market's or the S&P 500's only average return of 9.5%. In comparison to the S&P 500's 30% return, Berkshire Hathaway's total return during the time was 3.6 million%. We will therefore spend some time in this video listening to Warren Buffett's advice that is directly relevant to the investing environment that we will all be facing in 2023. So what exactly is that situation? Well, first of all, the market is declining and will feel 20% in 2022. Finally, rising interest rates will probably continue in 2023 as a result of the Fed's reaffirmation that it wants to bring inflation back down to 2%. We also have very high inflation, though happily it does seem to be coming down at least currently. Until they arrive, rates will continue to rise. Put all of that together with the potential for a year-long recession of some proportions. Consequently, investors have a lot to consider. So let's begin with the first problem. When the stock market is firmly heading down, what should logical long-term value investors do?
Let's talk a little bit about the fact that the market's down almost 800 points this morning.
Yeah.
Concern for you?
Well, no, that's good for us, actually. We're a net buyer of stocks over time. And just like being a net buyer of food, I expect to buy food the rest of my life, and I hope that food goes down in price tomorrow. When stocks are down, we're going to be buying on balance. And who wouldn't rather buy at a lower price than a higher price? People are really strange on that. I mean, because most people, most of your listeners are savers. And that means they'll be net buyers, and they should want the stock market to go down. They should want to buy at a lower price. And they have that feeling that they just feel better when stocks are going up.
This video beautifully highlights Buffett's logical reasoning. If you're under the age of 55 and a long-term investor looking to accumulate wealth, you really want the stock market to decline. The rationale for this is that even if you are 70 or 80 years old, you should still be a net buyer of stocks, since on the other hand, it's likely that you are at a point in your life where you are a net seller of stocks. And I appreciate that Buffett brings up how emotionally charged most people's responses to a collapsing market are. People simply feel better about purchasing stocks when the market is rising. But in truth, you should feel better about buying when the market is falling, as it is right now. And this connects to the following well-known investing proverb. The stock market is the only place people run out of the store during a sale. Consider the fact that even if we are constantly purchasing during Black Friday, we experience fear when Black Friday occurs during the stock market. In fact, the decline in the stock market should delight long-term investors. Listen to these two videos. According to Buffett,
some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all.
No, I mean, what are dumb things? Selling a stock because it goes down?
Selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, I'll pay you $15,000, you don't sell it because the quote's $15,000. But some people are not actually emotionally or psychologically fit to own stocks, but I think more of them would be if you get educated on what you're really buying, which is part of a business. If you worry about corrections, you shouldn't own stocks. I mean, if you can't take your stock going down, it's going to go down sometime if you own a stock, so why worry about it? I mean, the point is to buy something that you like at a price you like and then hold it for 20 years. And you should not look at it day to day. If you bought a farm or an apartment house, you wouldn't get a quote on it every day or every week or every month. So it's a terrible mistake to think of stocks as something that bob up and down, and that you should pay attention to those bobs up and down.
In conclusion, invest in great companies and keep in mind that market corrections are a regular aspect of investing and that they should make you joyful rather than terrified. That's investing in a bear market. But what about all this inflation we're seeing? Right now, the cost of materials is growing significantly, making everything more expensive for both businesses and consumers alike. What therefore must we take into account in a time of rising costs generally?
Keynes said it many years ago that it's an invisible tax that only one man in a million really understands. The best investment against inflation is to improve your own earning power. The best passive investment, I think, is a good business. If you own an interest in a good business, you're very likely to maintain purchasing power no matter what happens to the currency. But it's interesting, in the United States, the value of the dollar since I was born has declined by 94% to 6 cents. But things can work out pretty well even during inflationary times. I mean, if somebody told me when I was born, that the dollar bill is going to go to 6 cents, I might have said, let me go back. I'm not interested in emerging into that kind of a world. But actually, it's worked out pretty well, so I have no complaints.
Therefore, that piece of advice is really intriguing and contains a few concepts that need to be explored. First, boosting your personal earning potential is the best thing you can do during a period of high inflation. Make yourself more desirable to your current employer or potential future employers to increase your chances of seeing an increase in pay that keeps up with the inflation you'll experience.
Go into a drugstore, 7-Eleven or something, and you say, I would like a Snickers bar. And the owner says, oh, I've got something, the Musk bar, at 10 cents off the Snickers bar. You say, give me the Snickers. And if he doesn't give you the Snickers, you go across the street and buy the Snickers. It's probably easier to develop a new car than to compete with Snickers. But some products have terrific moats. Probably Elmer's glue does, WD-40. People that have an iPhone, they want to continue with the product that they've got. They want the new version. It's just easier for them. They've learned how to do everything, and their life's built around it and all of that. And moats are very useful. Costco has a moat in people's mind. I mean, Amazon can raise the price of Prime, 20%, and you can't do that unless you've built something within that image of the Amazon Prime that's based on reality, that you're going to get a lot for your money and you're going to want to use it. And then you can raise prices $20. But if you're selling, some commodity product, you can't do that. You need a moat. 1882 or 3, when the long government bond got to 15%, a company that was earning 15% on equity worth no more than book value under those circumstances, because you could buy a 30-year strip of bonds and guarantee yourself for 15% a year. And a business that earned 12% was a subpar business then. But a business that earns 12% when the government bond is 3% is one hell of a business now, and that's why they sell for very fancy prices.
Therefore, it's a really good business if it gives you 10 returns per year. However, if the risk-free rate approaches 10, more professional money will start to sell the company and instead opt to buy government bonds, which will result in a decline in the stock price of the company. So what can we conclude from all of this? Well, it's time to reiterate the need for us to maintain long-term focus while maintaining a laser-like focus on the performance of our chosen businesses. Because over a very long period of time, history has shown that stocks are, on average, a superior investment than bonds. That is simply the case. And basically, gentlemen, that is Warren Buffett's advice on how to handle the 3 major investing difficulties that we will all confront in 2023. High inflation, stock market correction, and rising interest rates. I do, however, sincerely hope that you learned anything from this video. So if you like this video, make it this far and want to see more like it, think about subscribing. In addition, I want to thank you all for watching, and I'll see you in the future video.